Hi, this is Spencer with the Harvard Mortgage Team, and today we'll be going over how do you qualify for a mortgage. So there's three keys to qualifying, and it really comes down to this first one, which is the debt-to-income ratio. The debt-to-income ratio is basically just a simple math equation that determines how much you can qualify for on a mortgage. Your credit score also is another key because that's going to determine which interest rate you get on your loan, and your down payment. That's going to determine the loan amount and even which loan program would be the best for you. So let's get right into the debt to income ratio because that's really the whole key to qualifying. So the debt to income ratio, or DTI, is just your monthly debt divided by your gross monthly income. And we need that ratio to be below a certain amount for different loan programs for you to qualify. So on the debt side of the equation, that's going to be the new mortgage payment that you're looking to qualify for, and anything on your credit report like car loans, student loans, credit cards, and personal loans. Things that are not going to be counted against you in the debt to income ratio will be car insurance, phone bill, utility bill, streaming services like Netflix, and anything that's not on your credit report we don't have to count. Credit score can impact your max DTI ratio. This is a good point, very important, because in general, if you have good credit above 740, then on conventional, you can go to about 50% on the DTI and maybe as high as 57% on FHA. But if you have poor credit in the 500 or 600s, or if you have some missed payments or collections on your credit report, then your DTI may be maxed out somewhere in the 40% range, maybe at 43%, which isn't going to allow you to qualify for quite as high of a mortgage payment. So let's get into an example so you can see some numbers here. We're just going to do a hypothetical person. We're going to assume this person has a good credit score. They're doing 3% down, which is the minimum on conventional. And since we know they've got good credit and they're doing a conventional loan, the max DTI is going to be 50%. If their DTI is below 50, they will qualify. So in this example, we're going to say this person earns $6,000 a month. That's their gross monthly income. And for debts, they've got a $500 car loan, $200 in student loans, and $100 in credit cards. So that's going to be a total of $800 a month in monthly debts. So 50% of their income, right, that's the max DTI, would be $3,000. So that means they can have as much as $3,000 of monthly debts. And we know they already have $800 for all their other stuff. So that is going to leave $2,200 remaining for this new mortgage payment. So then we know they can qualify for a $2,200 mortgage payment. We kind of just back into what would, what purchase price is going to be a $2,200 payment or below. So for this example, we're just going to pull out a random rate. It's 2024, so rates are around 7%. So we're just going to use that for this example. And if you're doing 3% down and we're estimating some property tax and home insurance at an interest rate of 7%, that's going to get you a purchase price of about $280,000, puts your mortgage just under $2,200 at $2,175 a month. So in this example, this person's going to be maxed out right around that $280 purchase price or so with 3% down. And again, if we look at their monthly debts, which we already knew were $800, plus this $2,100 mortgage payment, that's going to equal $2,975. That's their new monthly debt. And then to get the DTI ratio, we just divide that by 6,000, which is their gross monthly income, and we come up with 49.59. So that's below 50%. So they're qualified. That's pretty much it. It's a math equation, so it's below 50 as long as they've got the down payment in an account ready to go, and they've got the credit score. That loan is going to get approved. So this is hypothetical. Obviously, if actual rates and terms are going to vary depending on your credit score, and the property tax might be different in your state, so that's why it's important to talk to a loan officer to figure out which you can qualify for in your situation. So that's the basics. That's a really basic example of how it works. But a lot of times, people will get the news. They're like, $280,000. That wasn't really enough. I was looking at homes for $350,000, maybe even $400,000. So how can you qualify for more? So there's a couple ways to do that. First off, you can either put more money down or increase your income. And those are obviously a lot easier said than done. But if you put more money down, it's going to lower the loan amount, which will lower the payment. Can allow you to qualify for slightly higher price. If you're increasing your income, whether you get a raise or a new job with a higher salary, you're increasing the income side of that debt to income ratio equation. So that's going to help you qualify for a little bit more. Another option would be to increase your credit score. That's going to lower your interest rate a little bit. And if you had a really poor credit score, now if it gets up into the 700s, maybe the DTI can go a little bit higher as well. But, those are probably not going to move the needle a whole lot. What we see is a lot more common to really allow you to qualify for more is to pay off debt. Now, this is probably my favorite way to qualify for more, because if you're removing debt from the debt side of the equation, that's just more space for the mortgage payment. So like, for example, in that last example we had, that guy had a $500 car payment. If he could pay that off, that's $500 more he can pay on the mortgage. So instead of a $2,200 mortgage payment, he would be able to qualify for a $2,700 payment. We'd have to run the numbers to see how much more purchasing power that would be, but it could be as much as like $50,000 or so, purchasing power. Maybe he can qualify for up to $330 now. It's a pretty big shift. And the last way to qualify for a higher purchase price is to add a co-borrower. So this co-borrower can be living in the property with you, or it could be a non-occupying co-borrower like a parent or some sort of family member. But the key with any co-borrower is they just have to have more income than debt, because all we're doing when we're adding a co-borrower is we're adding their income and their debts to yours, and it all goes together in the debt to income ratio. So in our last example, if we add someone who has $10,000 of monthly income and only $1,000 of monthly debt, for example, you're going to be able to qualify for a whole lot more. So that is a few ways to kind of get around it and qualify for a higher purchase price. But those are the basics of pre-qualifying for a mortgage. So if you're interested in getting pre-qualified, the first step is to contact a loan officer, because each situation is different. So figure out, where the rates are at, where's your credit at, and what can you afford. Then you get pre-qualified, and then you can go out and shop with confidence. So that's pretty much it. If you guys have any questions, feel free to book a call with us on our website. Thanks.